Hello and welcome back to the Note. I have a correction to make. Back in August, you might recall, I said that while it was too early to say for sure, it looked as though the US stock market was moving into a true bear market and not just a correction. At this point, particularly after today's action, it does look as though that was merely a correction in the very late stage of a bull market rather than the beginning of a bear market. If we take a look at this first chart, you can see that the S&P 500 is now virtually level for the year. It's made up all its losses for the year. Its gains today have been led by the materials sector, most driven by concerns about China, the sector that had sold off most aggressively during that correction in August. Again, a sign that sentiment has come back. At one point, the S&P was actually up 10% from its low in August. So at this point, it really does look as though this was merely a correction rather than a bear market. Why is that? Firstly, earnings have at least been good enough. The results have not been particularly good, as I said yesterday. They have, however, been ahead of very low expectations. Even if they were achieved on the back of very poor revenues, companies have found a way to eke out some kind of an earnings surprise. There are also some exceptions to that, the most notable one coming after the market when Amazon, who had been expected to make a loss, instead surprised everyone by making a comfortable profit. Their shares were up more than 10% after the market, and we can expect that to continue in the morning. However, rather than earnings, the real impulse for the rise in US stocks today came from Europe. If we take a look at this next chart, you can see that German 5-year Bund yields, which went negative early this year before a rather sharp rebound, are back negative again, a very sharp fall, and that is because the ECB held a meeting and a press conference today, made it clear that they're prepared to consider yet more aggressive monetary easing before too much longer this year. Not only that, but that helps stocks across the world. It shows that there is more of that sugar rush from easy money to come, and it buoys the dollar. Even if the Fed isn't going to be raising rates as much as people thought, if other central banks respond by cutting more than thought, that still means that the dollar strengthens. And I can illustrate that for you with this chart. The blue line here shows you the extra yields you get on a 2-year Treasury compared to a 2-year Bund. And you can see that that has really driven the exchange rate of late. That leaves the dollar strengthening once more and leaves the pattern where, for now, it does appear as though the S&P, US stocks, US assets will continue to perform for the foreseeable future.